Good day. Welcome to our latest Fixed Income Market Outlook podcast. My name is Chang Ming, Head of Fixed Income Strategy at RHB Bank, Group Treasury and Global Markets. For today's podcast, we will provide updates on the IMF's recent economic outlook release, as well as our views on the US presidential election and the upcoming Malaysia's budget 2021. Outcome from the US presidential election is expected to drive investment sentiment as well as significant impact across financial markets. Prospects of a Biden-led presidency is expected to boost US fiscal stimulus spending further, which will again steepen the US Treasury curve from current levels. In the latest IMF economic outlook release, global growth is expected to contract -4.4% in 2020, a less severe contraction versus the forecast of -5.2% estimated in the June 2020 outlook release. The revision reflects better than anticipated second quarter GDP outturns, mostly in advanced economies, where activity began to improve sooner than expected after lockdowns were scaled back in May and June, as well as indicators of a stronger recovery in the third quarter. Going forward, global growth is projected to improve to +5.2% in 2021 versus a prior level of +5.4% predicted earlier. On that note, we opine concerted monetary easing response and fiscal stimulus are expected to support growth trajectory in the coming quarters, with a slew of third quarter releases scheduled for release. Recent release showed China's third quarter GDP staged a 4.9% expansion year-on-year versus a prior print of 3.2% in second quarter, suggesting the easing of movement control orders and reopening of economic activities have boded well for economic recovery. Meanwhile, the US presidential election will be closely followed by market players and investors, as the outcome is expected to drive investment sentiments and impact trade flows globally. Focus is expected to shift towards the upcoming US presidential election, scheduled on November 3rd, with Biden currently leading the polls. Under the Biden-led presidency, we expect the softer and more market-friendly approach to help revive global trade prospects. On that note, renewed catalyst for global trade is expected to bode well for growth recovery for most economies, especially for nations heavily reliant on trade flows. Meanwhile, a less friendly foreign policy approach under a Trump-led presidency will again elevate trade tensions further and may deteriorate the pace of global growth recovery. We view both outcomes to lead to weaker US dollar outlook due to fiscal stimulus spending, although a Biden-led regime may potentially lead to significantly higher fiscal spending and hence a more bearish US dollar outlook and a steepening of the US Treasury curve. Lingering concerns over increased supply of longer-dated US Treasury notes to fund fiscal spending needs have resulted in a steepening bias for the US sovereign curve. At present, the spreads of 30-year versus 2-year US Treasuries have widened to above 130 basis points from a mean of around 80 basis points, comparing a close to 2-year time frame. A closer look at year-to-date US Treasury issuances suggests longer-dated issuances represent circa 28% for tenors above 10 years and longer. We opine influx of longer-dated supply remains forthcoming for ongoing US fiscal stimulus efforts. On the local front, the upcoming budget 2021, scheduled for release on 6 November, is expected to remain a key watch for investors. Our RHB economic team expect fiscal deficit to improve to 5% of GDP in 2021 from an estimated deficit level of 6.5% in 2020. Fiscal spending currently embarked by most economies globally to aid recovery prospects is inevitable for now, given the urgency to revive growth traction. Going forward, fiscal consolidation is expected to remain on track in the coming years, given the lesser fiscal support needed once economic trajectory garners traction from reopening of economic activities. Budget 2021 is expected to remain in expansionary mode, albeit at a lesser magnitude. On a related note, the upcoming Bank Negara MPC scheduled on 3rd November remains a key focus for investors, as market players are shoring back prospects of further OPR easing amid the resurgence in daily COVID-19 cases. Currently, the 10-year versus 3-year benchmark MGS spread have widened back to around 80 basis points as the short end of the curve have tightened significantly as market players and investors expect further room for monetary policy responses by Bank Negara to support domestic growth given the increased downside risk to growth. On balance, we expect the monetary policy rhetoric of Bank Negara to remain accommodative, whilst the current OPR level of 1.75 is still supportive of financial market conditions. Going forward, we continue to reaffirm our views that the extended dovishness in the US Fed monetary policy outlook is expected to provide positive catalysts for Asian local currency bonds, including the ringgit bond segment, as real yields are still compelling. We hope this episode of our podcast has been useful. Thank you, and please continue to stay tuned to our upcoming podcast series in the coming months as we continue to share more updates in the fixed income space.